of the Royce Law Firm. We're a business, corporate, and tax firm in Palo Alto with offices in San Francisco, and we're starting the year with a bang for our webinar series. Our first one today on California incentives and multi-state sales tax issues for digital goods and services companies. And we're going to expand that topic to individuals, multi-state individuals as well. So I want to remind everybody that this webinar is being recorded, and you can go back and listen to it later. You can access the materials. They will all be posted on royceuniversity.com. You'll also find the webinar posted on the Royce Law YouTube site and available for download as a podcast in the Apple Podcast Store. The slides will be available on SlideShare. If you have questions during the webinar, you'll notice in the upper right-hand corner of your screen is a dialog box. You can type the questions in, and our speakers will respond to the questions after their presentations, or we'll get back to you separately offline. So this is the first webinar that we're doing of 2015, and we're going to start off with the technical topic. We're talking about sales tax and other tax issues, state tax issues today. I just want to remind everybody that our next webinar will be in date to be determined in mid-February on the interesting area of film tax, where Hollywood meets Silicon Valley. But for today, we're going to discuss various state tax issues for companies and individuals doing business in California. Our panelists are going to cover recent developments in California income and sales tax, tax credits and incentives, multi-state tax issues for tech companies, and state residency planning for individuals. So our speakers include, aside from myself, Roger Royce, the founder of the Royce Law Firm, we also have Monica Miles from Miles Consulting Group. Monica founded the Miles Consulting Group in 2002. The firm focuses on multi-state tax consulting. It helps its clients navigate state tax issues such as sales tax and income tax and interstate commerce, including e-commerce. We also have Dave Wittrock from Price Wittrock CPA, LLP. Dave is a tax CPA and an attorney with over 36 years experience in public accounting and in private industry, and is also a frequent participant in our webinar series on various tax issues. He's currently the managing partner of a small specialist CPA firm that advises corporations on tax matters and financial accounting. We also have Dave Spence, an attorney here at the Royce Law Firm who heads the Estate, Trust, and Wealth Strategies practice. Dave's practice focuses on the areas of taxation, estates, trust, and private wealth structures used in the management, protection, and transition to succeeding generations. Dave's clients tend to be international and domestic individuals, family businesses, charitable organizations. So I thought I would just kick things off with just sort of a handful of interesting, we'll call them hot topics, although I don't know how hot they are, they're just more interesting to me. And why don't we turn to the first slide, Henry? So this is sort of a non-event. When I created this slide a month ago, I called it health insurance nonconformity. But since then, the state of things has changed. A few months ago, one of the state tax publications had reported that the FTB had advised that California was not going to conform to federal law with respect to the self-employed taxpayers' deduction of health insurance premiums that were refunded under the ACA tax credit regime, the Obamacare regime. Since then, the FTB has clarified that they are going to conform. So this is sort of a non-event. And the only reason I'm mentioning it is because I believe there probably are still a lot of people out there who haven't gotten the news and who might think that there's a difference between the treatment of self-employed health insurance deductions for federal and state tax purposes. And if you take a look at the statutes and the regulations cited there, you'll see that they are going to happily coincide. Next slide, Henry. I will mention that there are some areas of tax nonconformity that still exist in the law. As you know, we've got the tax extenders, but we still have some areas where California tax does not conform with federal. The one that you probably heard most about is cancellation of indebtedness income resulting from the reacquisition of debt. Under federal law, taxpayers can defer and spread that sort of COD income out over several years, over a 5-year period. California did not comply with that provision, so the income would have been taxed in full. So the corollary is that any federal income that they would pick up in 2014 and beyond is going to be excluded for California purposes since it's already been picked up. Tax depreciation, California does not comply with accelerated deductions under MACRS and ACRS. And then the federal tax extenders. As you probably know, in December, Congress extended certain tax provisions that had expired. It's important to note that California does not automatically conform to those extensions. Exclusion of discharge of indebtedness income on principal residence, expense elections under 179, bonus depreciation. I guess the biggest one is the reduced built-in gain holding period for S Corps, 5 years federal, 10 years state. Next slide, right? So here's sort of an interesting case that came up. If you've ever wondered if an out-of-state corporation was deemed to be doing business in California by virtue of holding an interest in an LLC, we now have a case on this issue, so we have case law authority. And the court likened an interest in an LLC to be very similar to a limited partnership, and said that's an investment in the corporation. Because the corporation, as a member of the LLC, wasn't the manager, they weren't doing business in the state, meaning that the corporation didn't have to get into the system and pay the minimum $800 a year minimum tax just because it owned an interest in an LLC. Note that this corporation had only a passive interest. It wasn't the manager. And again, the corporation was more like a limited partner than a general partner. And this is contrary to what would happen if a company or a non-resident owns an interest in, for example, a general partnership where they're deemed to be engaged in the trade or business of the partnership. Different rule with LLCs. A couple of things is, if you practice in the area, you probably have been watching the Franchise Tax Board's assault on 1031 transactions. They audit these regularly, very concerned about drops and swaps and additional reporting requirements. Well, from January 1, 2014, we have another information return that has to be filed, the Form 3840, for any taxpayer that completes a like-kind exchange. And this time, the abuse they're going after is when property gets exchanged for property located outside of California. It has to be filed for the year of the exchange and every subsequent year until the gain is recognized. So just a little gotcha to be careful of. Here's an interesting bit of legislation. These nonprofits, well, corporations generally, but in this case, nonprofits that sit around and don't pay their taxes and eventually get suspended after a while, and they just sit there on the state books forever and ever, and they keep sending notices out to the taxpayer. There was a very sensible piece of legislation that would have allowed for an administrative dissolution just to get those off the books, wipe out the California tax liabilities, and move forward. The governor vetoed that bill on the basis that it would have required, apparently on the basis that it would have required reprogramming of a computer system that's due to be replaced. So we're going to continue with this inefficient system that employs a lot of people to do nothing. I don't know which political union he owed a favor to in that particular case, but that's what we've got right now. Other hot topics, in case you were wondering, asset sales and bankruptcy reorganizations. That is not necessarily qualify for the occasional sale to be exempt from sales tax. In this particular ruling, it was a series of asset sales made over a period of 2 years, and the FTB said, well, that's not an occasional sale in a bankruptcy reorg. Here's interesting. California has a motion picture tax credit if you do any work in the film industry, and it's been $100 million a year, and it's first come, first served. The first 100 million gets doled out, and that's a drop in the bucket. In fact, it's laughable considering how large California's film industry is and what sort of incentives other states offer. It's not great, but it's better now. It's been increased from 100 million to 330 million, and the law has introduced a competitive system that's going to allocate the money based on the type of production and the number of jobs created. It's also available for television series and television pilots. This is kind of an interesting note. Marijuana. If you've been following what's been going on with the cannabis industry, you probably know that there is this huge disconnect between federal law and state law. Even though many states, California, for example, allows medical marijuana, and other states allow limited amounts of marijuana to be sold in any case for recreational purposes, I suppose. Even though that's true, it's still illegal under federal law. It's a violation of the Federal Controlled Substances Act. And you've probably heard that means that expenses that are incurred in a marijuana business are not deductible, which basically increases the effective tax rate for a lot of these companies to 100% sometimes, or thereabouts. And there's been legislation introduced federally to try to solve that problem and fix that. I'm not aware that any of it's passed yet. For purposes of state law, since this is a state tax webinar, one of the things to note is that these dispensaries are having problems opening bank accounts as well, because banks don't want to take on a business that's illegal, especially one where our Attorney General's office has said they're going to prosecute anybody that has anything to do with a cannabis business. So several banks are refusing to open these accounts. Now, we could spend an hour talking about what's going on with the law regarding bank accounts for cannabis businesses, and suffice it to say that there is a way that companies can open those accounts with an expanded reporting. The bank has an expanded reporting requirement to the federal government. However, what's happening in effect is that these businesses are just doing business without bank accounts, all cash. You can see what a great idea that is in terms of compliance and enforcement, but also for the businesses, they have to pay penalties because they're doing their business in cash and can't use online systems, etc. So that's something that's just, the law on this is just all mixed up and in flux, and I'm certain it's going to change in 2015. It just has to. So with that, I think what I would like to do is turn the discussion over to Monica to discuss and talk about California credits and incentives and something called a Go Biz program.
Great. Thank you very much, Roger. I appreciate it, and I appreciate my fellow panelists today. I'm excited to be here today to talk about California's newest business tax credits and incentives. They've been around for a little bit, but they're still relatively new. Here's just a brief intro about me. As Roger mentioned, I have a background in Big Four public accounting. I've had my own firm for about 13 years, and we specialize in multi-state tax issues. So we do a lot of nexus reviews, taxability studies, and we also specialize in maximizing credits and incentives for our clients. And so that's what we're going to focus on today, is the California credits and incentives. Some of you on the call today may be familiar with the former Enterprise Zone program here in California. It had been around for 20+ years, and it offered credits to businesses in distressed areas, these enterprise zones. There were 42 of them across the state of California. It benefited businesses in the enterprise zone by offering a hiring credit, a sales use tax credit, and also banks making loans into the enterprise zone program. And just by way of a little bit of background, the governor here in California had long wanted to eliminate the enterprise zone program. And in June of 2013, he was successful. The legislature eliminated the EZ program and essentially replaced it with these three programs. And there was a little bit of politics there. If he had just eliminated the enterprise zone program, that would have been a tax increase that would have required a 2/3 majority. And so instead, we replaced it with these credits. And you can't see me, but I'm doing air quotes around replaced because I'm not sure that these necessarily truly replace that in a good way. But suffice it to say, here is what we have, and I've listed them here, and we're going to talk about them in order of usefulness, as I believe, in my opinion, the manufacturer's partial sales tax exemption, the California Competes credit, and the new hiring credit. So let's talk about the manufacturer's exemption first. This exemption, it's a partial exemption, began July 1st of 2014, so we've had it for just 6 months. And it allows certain manufacturing and biotech companies to exempt from sales and use tax their purchases of manufacturing and R&D equipment. The exemption amounts to $4.1 0.875% of California sales tax of the purchase price of the qualified property, essentially. And since the exemption is partial, record keeping is going to be key, and I'm going to continue to say that several times today. The kinds of companies that will benefit from the manufacturing exemption are those in a qualifying NAICS code in the 3000s. There, the 3111 to 3399 are qualified manufacturers. It's most of the companies we'll see here in Silicon Valley that are truly manufacturing. Doesn't include software companies. And then also the biotech industries in the 54 series there that you see on your screen. So those are the companies that will qualify. What's the type of equipment that will qualify? Purchased equipment or machinery that's used 50% or more in the manufacturing process. Also, as I mentioned, equipment and machinery purchased and used for R&D qualifies as well. And again, this has to be used here in California. In any given calendar year, the combined amount of purchases that would qualify cannot exceed $200 million. So that's quite a bit. It's a nice threshold. Any purchases beyond that will not qualify, but the next year it starts again. So there's just a little bit of planning, that maybe needs to be done there. For those in the audience that might remember the manufacturer's investment credit that was around in the 1994 to early 2000s, there are many similarities, but this is truly an exemption from sales tax, where the MIC was taken against your income tax return. This is truly taken on the front, which is nice. It's similar to a lot of other states. And the way to claim it is that the purchaser of the equipment will provide the seller with an exemption certificate stating that they qualify. The seller then takes that in good faith. That's going to be Form California 230M. And they can claim the partial exemption, and then the seller will charge the reduced sales tax. Also, if you purchase equipment from out of state, you can pick up the reduced amount of use tax that will be due on your use tax return. So it seems easy, seems like a logical thing. What gives? There's not a lot of what gives, actually. We just are really talking with clients about making sure they have the proper documentation in everything that they do. There are some interesting new rules that actually have been written into the statute, which we like, under establishment. We talked about qualifying NAICS codes. The nice thing about this is there's some rules built in, even if you have an industry whose main NAICS code may not be in a qualifying manufacturing area. So let me give you an example. Let's say you have a bakery, for instance, within a grocery store. So a grocery store isn't in a qualifying NAICS code, but a bakery itself might be. And so if you can break out the P&L, or you have a separate line of business, and you meet some of the qualifications of the regulation, you could claim the machinery and equipment in that bakery. So again, there's documentation that needs to happen. You need to properly document it, but it is nice that that's in there. So if you are a business whose main NAICS code may not be manufacturing, you may still qualify if you can break out your P&L. Again, audits on this are going to be in the future. It's important to have contemporaneous documentation available, because you're going to have to document this 2 or 3 years from now when you're audited, and you want to make sure that you have that. It's going to be key, because if you have overstated the exemption because you ultimately lose it because you can't document it, you can also create financial statement distortion. It's a big enough credit. It's probably material in a lot of ways. The types of things you're going to need to be able to document upon audit, you're going to have to be sure that you're in a qualifying business, that the asset was used in a qualifying use greater than 50% of the time, that it didn't get moved outside of that use within a year. You want to be able to probably document for larger pieces of equipment. You may want to take pictures of where it is on the line, and things like computers that are smaller. If you're claiming a lot of computers or servers and things like R&D, you're going to want to make sure that those do truly stay in use in the qualified activity, or that you can document that. And those are some of the things that we help our clients with. Also note that this is difficult to recover retroactively. Since your giving the certificate of exemption to the supplier, they're the ones that charge you the reduced rate. If you didn't take it at all, it's your supplier you have to go back to, and they have to go apply for the exemption or for a refund from the state. So you can't go back directly and say, hey, I forgot to do this. Can you give me the refund? You have to go back to your supplier. So it's still relatively new. It'll be interesting to see how many folks will go back and do that on your behalf. That said, the numbers can add up quickly. So if you have, just $1 million of qualified investments, $41,000, $10 million, $400,000, they add up quickly. So it's a good number. Here's some of our recommendations for success as we're talking to clients. Definitely make sure that we document all of these things, particularly when the numbers are material, and obviously that can happen pretty quickly. But these are the things that we help with that qualification, with the documentation, do some selected asset testing, and creating an auditable deliverable so that when that auditor does come in a few years, you have it all in one nice place. All right, let's talk about the California Compete Tax Credit. This is a very interesting new animal, if you will, here in California. We've never had anything quite like this. It is an income tax credit available for companies that are expanding in California, so existing California companies, or those that are coming into the state and looking to employ people and property here. Both sets of those types of companies, either the existing California companies or the out-of-state companies, submit applications to the state detailing what that investment is going to look like here in the state, and then they request a specific amount of money. So it's not your typical credit where if you have head count of X and you employ so many, it's times a certain number. You come up with a number yourself that you're going to request. So that's interesting. We'll talk a little bit more about that in a second. But it is a competitive application process for limited funding. The first year that it was available was the fiscal year ended June 30th of 2014, and it was $30 million in that year. This year, the fiscal year that ends now in June of 15, is about $150 million that is being allocated. So it has increased a little bit. The submissions are vetted by a 5-member panel that's been appointed by the governor. So, as a pessimist a little bit, I would say that there might be some backroom deals going on, but what do I know? That's the pessimist in me talking. The process is transparent from the standpoint that once the decisions are made as to who gets the funding, that information is made public, but how the sausage is made, if you will, is a little bit, it's not as transparent as maybe we'd like it to be, so we're not quite sure how that's happening. But it's a two-phase system. So the first phase is you go online, you fill out an application with all of your company specifics. It's pretty straightforward. You talk about a little bit about the investment you're going to be making and what you're looking for. And then there is a second piece, and some of these are the evaluation factors that they're looking for. What kind of benefit are you providing to the state? Is there going to be future growth and expansions? Are you being wooed as a company by other states? Is there competition? Should California really give you this money because they're afraid you're going to leave? Those types of things. Are you taking advantage of other types of credits already available? Like one of the questions on there is, are you taking advantage of the new manufacturing exemption or the new hiring credit that we're going to talk about in a minute? So there's a lot of information. It gets vetted, and if you make it through phase 1, then you go to phase 2, and that's where some of these questions get vetted. It's interesting. It's interesting to see how this is going to play out. The applications are out there online and can be accessed pretty much by anybody. Here are some considerations that are interesting about this. Again, there's 25% that's set aside for small businesses. And small businesses are those that have less than $2 million of gross revenue. Again, some of us feel that that was largely political. So we need to increase benefits for small businesses because, quite frankly, if you've got a small business that's got less than $2 million of gross revenue, how much income are you going to be paying, and how much income tax credit is there really going to be available, and do you have the wherewithal to go through the hoops and actually go after this? We hope yes, and we hope there will be some benefit for small businesses. Note that there's also an increasing annual benefit pool. I talked briefly about the numbers, $30 million in fiscal 2014, $150 million in fiscal 2015, and $200 million in 16 through 18. My bullet here on ratio management being key, this is where this gets particularly interesting. It's in the amount of money that you're asking for. So all things being equal, if I, as a company, invest $100 million in California and I ask for $1 million of tax credits as a result, and somebody across the aisle is also investing $100 million in California and they're requesting $2 million of benefit from the state, I'm likely to get it because I have requested less money for my investment, and therefore the ROI to California is bigger. Of course, the rub there is we don't know what other people are asking for. The conventional wisdom thus far, and again the program's only been around for a short period of time, is that companies will not be successful if they request too much, obviously, and right now that ratio appears to be about 1%. So in my example, $100 million, shouldn't be asking for more than $1 million in tax credit. And again, total generalization on that, that's based on one round of funding thus far. Here are again some numbers. You'll note by this slide that we are currently in an application phase. So there are, for every year the money is given away, there's different periods during which you can apply. We're in one right now, January 5th through the February 2nd, and during this period they're going to give away $75 million, or they're going to, not give away, but they're going to assign $75 million of the $150 for this year. So this will be the biggest tranche of money, if you will, that they've given away yet to date. So it's an interesting process. It's an interesting time. If you think you have some of these tax patterns, please give me a call. We can talk through some of them. The next application period for this year, the final one for fiscal 15, is going to be March and April. Here are some areas that we can help with. We can assist clients with initial go or no-go evaluation. We work with assistants in phase 1, the ratio analysis in phase 2.
Analysis in phase 2.
Sorry, I was laughing. My bad.
All right. Sorry if we had a little disturbance there. That was not me singing, but we'll get back to it. Okay. I've only got a few minutes to finish up here, but I'm going to talk very briefly about the new hiring credit. This is something that was touted quite a bit. It is supposedly replaces the enterprise zone hiring tax credit. What is it? Who qualifies? We're going to talk a little bit about that. It's a 35% credit. It sounds great. A qualified employee can generate over $50,000 over a 5-year period if they stay with you. The old enterprise zone credit was just over $38,000 over the same period. However, it's much harder to qualify for than it was under the enterprise zone program. A lot of hoops to jump through. It's a credit for hiring certain disadvantaged workers in specific geographic areas. It can be up to $56,000. And I've given this presentation a few times, and I always get to this part. Who qualifies? Nobody. I am just kidding. Very few people, however, will. Sorry. Okay, we'll talk about who does qualify, but when you see who does, you'll probably agree with me.
It's my in-law.
Somebody's in-laws, yeah, somebody. So here it is. Who qualifies? Companies that are located in a certain geographic area. Again, we're digging up the old, dusting off the former enterprise zones. It's designated geographic area is what it's called, but it's mostly the old enterprise zones plus some other specific census areas that encompass the largest unemployment areas in the state. You have to be in industry that's including in manufacturing, biomedical, aerospace, and technology sectors, and you have to have an increase of jobs over a base year. So that's a significant change from the enterprise zone. Here are some of the employee qualifications. You have to be paying wages of between $13.50 and $31.50 an hour, and only the amounts over that minimum wage, the $13.50, that's the 1.5 times minimum wage, are going to even qualify. So again, unlike the Enterprise Zone program, which was on those first wages, this is just on the wages over. It's for anybody hired after 1/1/14, and these are the qualifying categories for employees. Again, a much shorter list than the prior Enterprise Zone. Also, the employer has to request qualification for an employee within their first 30 days of employment. So you may not even know if the person's really going to qualify, but you have to get a certification form in. So lots of hoops to jump through. I'm going to give you an example. So I told you nobody was going to qualify. We actually had a client here in the Bay Area. They were located in a specific zone. They were a light manufacturer. They were hiring 80 people. We thought it was going to be a significant benefit. They were, unfortunately, their starting wages for those jobs were fairly low. Although 14 to 15, not too bad. We figured out that their benefit was estimated to be less than $20,000 over a 3-year period, assuming about 10% of their employees qualified. Here's kind of the math on that, just to kind of show you the benefit. Again, not to belabor the point about the Enterprise Zone credit, but a similar analysis, we looked at this and said that this same client would have probably, over this period, over this 3-year period, had over $200,000 of benefits. So significant reduction because they weren't paying high enough wages, essentially. So how to succeed in this program? Definitely do some initial evaluation and preliminary calculations to see if it even makes sense. If you think you are going to be one of those few taxpayers that may qualify, you'll definitely want to develop processes to fill out this paperwork so that you get that documentation in as soon as possible, and be prepared to do all the qualifying support and calculations and maintain it all, because it will be audited for sure. This is my analysis of these 3 benefits. You know, I do think that the partial manufacturer's exemption gets a thumbs up. The California Competes tax credit, we're kind of neutral on that because we're just not quite sure if it's really going to benefit a lot of companies or if it's going to benefit you know, some of our clients that we're trying to help with this. The hiring credit, we're giving that guy a thumbs down. Again, these are my opinions, but we just think very, very few people are going to qualify for that. Here's some final thoughts for you. These are some things that we can assist with, in relation to any of the credits we talked about today or the exemptions. We offer a monthly newsletter, weekly blog, and some complimentary individual consultation. If anybody on the call today is interested in any of the programs I talked about, please feel free to contact me for complimentary consultation and a high-level analysis of benefits for your company. We can do a back-of-the-envelope calculation and see if you can benefit from any of these, and if so, we're happy to help with that. Just reference the webinar. My contact information is going to be below. And also, if you'd like to sign up for our monthly newsletter, we discuss these kinds of credits and incentives opportunities and also general state tax topics. So we're going to leave questions for the end, and I'm going to pass it back to Roger.
Pass it over to Dave.
Okay, we'll pass it over to Dave. Thank you.
Thank you very much, Monica. That's really interesting.
Left slide here. Okay, so let's get into sales and use taxes for what we call digital goods and services company. First of all, my firm name really is Price Whitrock. My partner's name is Price. I didn't just try to game the system like we're one of the big 4 firms. That's really your name. What I'm going to do today is try to stay more conceptual and avoid too many technical rules. But I'm going to finish up with, okay, what do we do about sales tax if you're in this kind of a business? So what do I mean by digital goods and services companies? Here's some examples of the types of business models: software as a service, that's SaaS, platform as a service, infrastructure as a service. Salesforce is one of those. It's probably software as a service. And you can see these others here, including sharing economy companies like Airbnb, which was a client of mine. I did work for that company when they first started up along with my team. And they really kicked off the sharing economy. And you can see the others here. I don't know how many of the participants in this web conference are in these businesses, but almost all of you are buying from these companies, and you really need to know whether your purchases are subject to sales tax. So let's go through a few thoughts on the sales tax traps that you should be looking for as a digital business or buying from them. It used to be in the old days that software was taxed, certain software anyway. Back in the day when I was up in Washington, the big issue with Microsoft in about 1981 we were dealing with was whether shrink-wrap software was tangible property. And that evolved into taxing all versions of delivery of software. But that really is the old battleground. Nowadays, states are applying their taxes to things like what they call data processing, information services, and a variety of other definitions of what we would consider to be services, or types of businesses that are really providing a service that traditionally has not been taxable, but they use technology in performing their services, like a SaaS company. And here's a listing of some of the states that have passed legislation. The worst ones are New York, D.C., Ohio, and Texas. You could add New Jersey to that list. New York has kind of a double-barrel approach, as does Texas. So those are two to really watch out for, because they're very expansive in what they think is subject to sales tax these days. One of the key points is that the tax director looking at these issues, or the tax advisor, is you have to understand the product very well, what is being delivered, what is being purchased, and what does that mean in terms of what triggers the tax. When we did some work for Airbnb, we found that whether there was a tax at all and who the tax was on and the measure of the tax depended, in one case, on whether it was a tax on a hotel stay, that is, from the guest perspective, is it a tax on the guest, or is it a tax on providing a hotel, which would be a tax on the apartment owner or the host. Also in software, you get into some of these terms like transferred electronically or delivered electronically. There are huge differences in the tax consequences of how these terms work. So tax people have to understand what's being delivered, how it's being delivered, and get close to the product managers in the company to get your arms around that. Here's a list of some of the questions I go through when I talk with a company that's providing digital goods and services. We're not going to go through all these today. We don't have time, obviously. And you can see that there's quite a bit of fertile ground here for interpretation. What you're doing is trying to tax intangibles now and services when you're a tax jurisdiction, and that's different than taxing tangible property. There's so many instances in which a taxation event is not even clear. What's the incident of tax? What triggers the tax? And what you're going to find is that it's not clear with these intangibles. So let's just touch base on a few things. Nexus, I'm not going to dwell on at all. If you're a very early stage company, Nexus is fine to hide behind. That means the states don't have jurisdiction to cause you to collect sales tax. However, once you start to grow, Nexus is almost certainly going to be very difficult to use as a barrier to tax exposure. What you should look into is what is the customer really buying and how is it used? This is obvious to the company, especially the product people, but the tax authorities have a difficult time with it. I was submitting a ruling request to New York for a company that received emails and performed certain functions on the emails on its servers and then sent the emails back out to its customers. And it took 4 or 5 rounds of descriptions and pictures and line charts and boxes and drawings, technical and non-technical descriptions, to get them to even begin to understand what the company was doing. By the way, as an anecdote, at the end of the day, New York agreed with me that that was not data processing or information services or software, but they then added, yeah, but you're a security business and taxed like a Brinks truck because you secure the data. So those are the kinds of things that can come up from nowhere. By the way, if you have an online marketplace, for example, is that data processing? If you provide a marketplace in the cloud, is that information services? Is that professional services? Is it software? Well, it has elements of all of these. And you get into what's the principal purpose of the purchase by the customer. What are they really looking for? Because everybody in this room and everybody listening to this webcast uses data processing and providing their services. We're doing that right now as we speak, but that doesn't mean that The charge for some of the seminar would be subject to sales tax just for their data processing or information services. Okay, who's buying it? Main point here is don't rely on resale exemptions when you're getting into intangibles, unlike tangible property. It's easy to trace through some aluminum to a Boeing airplane. Back in the old days, you know, like I used to do up in Washington for resale exemptions, but it's much more difficult to do for services. Okay, this is one of the slides that has a lot embedded in it between the lines. It almost gets into the metaphysics of the new online businesses. Let's just say that you're an online marketplace and you provide a way for people to get together and buy and sell things. A good example of that would be HomeAway, which is a competitor of Airbnb, a way where you can get an apartment to stay. But HomeAway historically has not handled the payments. You as a guest pay the apartment owner directly, so HomeAway wasn't involved in the payment streams. Once you cross that line, though, and start facilitating transactions by handling the payments, even if you set it up through PayPal, if the money goes through a bank account assigned to you, and that bank balance, even if it's restricted cash, is sitting on your balance sheet, you may well be responsible for having to see to it that sales taxes and other types of taxes are collected on the underlying transactions. So this is really a key point here, and Apple and Google pretty much figured this one out. You know, they have the Apple Store and Google Play, and they generally do collect sales tax when you're selling through like an iOS agreement through Apple, and they collect their 30%. It says in the agreements that Apple and Google are just marketing agents handling the distribution of the goods you are selling. Nevertheless, they're handling the payments, and they pretty much have admitted that you follow the money like in the old Watergate days. States are going to cause intermediaries to have to collect the tax. Now then, supposing you are able to convince the taxing jurisdiction that you as an intermediary are not responsible for collecting the tax, like legally you're not, because the state law or city ordinance doesn't require you to be jointly and severally liable, or you're simply not considered to be the party making the sale for purposes of sales tax. In that case, you could do what we did a couple of times, almost shot ourselves in the head, not the foot, when we would give rulings. I've got rulings for clients where the intermediary was not taxable, and the tax authority invariably says, okay, that's fine, now give me a list of your customers, we're going to go after them. And we want to know names, addresses, and amounts paid to them, which is worse than just collecting the tax on behalf of the customers. So there's public relations aspects to this, and you may find that a jurisdiction will be asking for a list of your customers if you're an intermediary, even if you're not responsible for the tax. Colorado, by the way, tried to do this to all multi-state sellers, regardless, that were selling into Colorado, who admittedly had no in-state presence or nexus. So Colorado could not cause those out-of-state sellers to collect tax. So Colorado asked for lists of in-state customers to assert the use tax, and that was, I think, overturned, wasn't it, Monica? I think it was overturned by the courts or otherwise revoked by Colorado. Okay, this is kind of off point, but the last bullet here is don't overlook every element of your transactions and every payment stream. Get up on the whiteboard and start drawing boxes of lines of where the money flows, where title passes, where the physical product passes, where the invoicing goes, and whose books everything ends up on. Because you might find that while you may be clear as an intermediary from the obligation to collect sales tax or see to it that it's collected on the underlying transaction, there may well be a tax on the commission or the fee in the middle. Amazon Web Services, for example, which almost everybody uses, in some cases charges sales tax on the AWS service fee itself. You also get into issues of what's the measure of the tax if there is a transaction and there's a commission that comes out. If someone sells through a distribution channel, an online distribution channel like Apple or Google, and you as the seller receive a net amount of 70%, what is the sales tax measured? Is it on the 100% or the 70%? And so you get into those issues as well. Okay, how is the software transferred? You can see there's different ways it can be transferred. Again, this have all the difference in the world is the taxability. Where is it used? States are just beginning to deal with a multi-state issue. I had a client where we provided certain data storage and retrieval for large data users, and my client had a customer in New York that had major offices in Ohio and Washington, D.C., and it turned out all three of those jurisdictions tax data processing. So we then were trying to figure out where is the tax even due when we invoice the New York headquarters, and it's not a solution to say, well, let's just prorate it based on where the usage is, because, well, usage over what time period? The usage changes minute by minute. So on Tuesday, D.C. may have 80% of the usage, and on Wednesday, D.C. may have 3% of the usage. And it's a tax on a transaction. Different states have taken different approaches to that. So you have to watch out for multiple points of use, they call it. This is a case where Texas, of all places, has an inspired rule that actually lets the seller get a certificate from the buyer and lets the buyer figure out where the use is going to be in multi-state. Okay, how is it paid for? This can affect, again, the treatment of the transaction as taxability. Exemptions. Exemptions are sometimes based on these bullets, as you can see. Everybody's familiar with these. Once again, it's difficult to apply these to companies that are buying intangibles and information services. All right. When I start to look at these issues, though, at the end of the day, what do you do about all these complexities? I mean, the decision tree looks like, you know, a plate of spaghetti. It goes out in all different directions. So first of all, what I do is try to figure out how much tax is due here. How much are we talking about? What does the statute of limitations period look like? That's the state's calling right now. So they also, you know, you've got to consider the different local rates, penalties, interest. Watch out for the grossing up of the tax base. If you did not collect sales tax on your sales and it turns out they were taxable, that it could be that you've got to gross up the calculation of what's subject to tax. You don't necessarily get to take the sales price and multiply it by the tax rate. You may have to take the sales amount, multiply by the tax rate, add it to the sales price, and then apply the tax rate to all of that. Also, if you have any like imports from Europe, or even exporting services to Europe, they have a VAT over there, and they have a concept called electronically supplied services, ESS, which is a way of extraterritorial tax application. And you can have instances, I've seen them, where you double up and you have VAT and sales tax on the same transaction. It's rare, but it can happen. In that case, you have tax on tax on tax, and it gets to be a circular calculation. The idea, though, is let's figure out how much tax is involved and how many different jurisdictions. Pick off the large ones. Usually, if you pick in my experience, the top 6 or 8 states are going to give you 75% of your tax. Once you do that, then think about the administrative cost of filing. You know, you have to take somebody, a full head count person, for a couple of days, once a month, to work through the tax filings and the forms, and you have to reconcile your sales tax collections to the amounts you've remitted. You have to tie this all back to your general ledger in detail, use big spreadsheets and databases, you know, keep track of all this stuff. So there's an administrative cost. But probably the worst is the second bullet on the slide. The registration information you have to submit to register in a state for sales tax is positively frightening because the sales tax is something that's trust fund money, and states are paranoid that companies are going to collect the tax and not remit it. So as you can imagine, when you register for sales tax, I've seen states ask for not only officers' home addresses, but their bank and their bank branch where they personally do their banking. We've refused to give bank account numbers, social security numbers of corporate officers. That kind of information is going to be put on the registration, so you don't want to lightly do this. Fortunately, you don't have to register in every state where you have sales, but in those that you do decide to register, you know, this is a bit of an issue that you have to prepare management to deal with. At the end of the day, it's never a problem, but it's pretty daunting when you're looking at something like that. Message here is don't worry so much about what customers think. Most of the time, and by most of the time, at least Monica, I don't know about you, but like 80, 90% of the time, once we finally start collecting tax and telling customers we're going to collect, they say, what a relief, thank you. Because we kind of figured the tax was due, and we don't want to mess with self-assessment. So you'd be surprised how often. Is that kind of your experience, too?
It is until you get to bullet point number 2 here, and they claim that there might be a competitive disadvantage.
Exactly.
Yeah.
You wonder how significant that really is.
Yeah.
Sometimes these taxes are a surprise, but most of the time the customers know. And most of the time, what I've heard, most recently heard a couple days ago, is why is your client not charging sales tax to us? The old supplier we had that was providing the identical commodity to us or service to us was charging sales tax, but you're not. So anyway, you can run into those issues. All right, broader perspective. This is something we talked about earlier, the regulatory environment. A lot of these sharing economy companies are running into regulatory hurdles. I have a client that provides parking spaces, and it's not one of those parking space water thing. I mean, it's more where you can rent somebody's driveway or a church parking lot, and the regulatory barriers are just almost insurmountable at times, it seems. So sometimes what cities do is they'll say, I'll tell you what, we'll tax you instead, which is actually a victory, rather than dealing with the regulatory issues. What's your board's philosophy? A couple of times, that hasn't happened recently, but when I was younger, I'm an old guy now, but when I was younger, I'd go in and proclaim tax savings in a clever tax position, and a board member would just kneecap me with, that's not his philosophy on what good corporate practice is, or they got burned by that somewhere else or whatever. So make sure your board, you socialize it with the board. Due diligence, if you're going to do a financing, sales tax is probably the #1 deal killer I'm seeing in tax, and maybe in the top 5 in all deal killers. I've actually seen deals killed by that. Public opinion, which we're seeing a lot about these days. And then there's some federal laws and streamlined sales tax proposals to simplify things. Okay, what to do? Last slide. First of all, make a policy decision on where you're going to start collecting sales tax. I usually say if you have revenues in the U.S. of $10 million, it's going to hurt if you don't collect tax where you have to collect it. And then you have to break that down into states. Maybe if you have something like $200,000 of sales in the state, you're going to be running up $15,000 or $20,000 a year of sales tax exposure. Is that your point of pain? You just need to make a policy decision on that early on in the company and review that at least annually or every 6 months or even quarterly. Secondly, get the VP of sales involved to check consumer reaction as to whether they care if tax is going to be applied. Sometimes customers actually feel like you're not doing it right. You must not be a first-class operation if you're not collecting tax. So get those guys involved. A budget for the administrative costs. You're going to need a partial head count to take care of this stuff. It's hard to get this done with your existing staff. Maybe you're lucky enough to have somebody in your AP department or your revenue side that has some experience. Otherwise, talk to somebody like Monica who can get you set up with some automated tools. Also, put some language in your contracts, including click-through licenses, any kind of protection that says the customer agrees to pay applicable sales tax will help you later on. And finally, at some point, I hate to be the bearer of bad news, just plan ahead, because sooner or later, look, the tax is due, right? And so it's just a matter of whether you get caught and you have nexus, and implementing a sensible policy to deal with administrative costs is better now rather than trying to deal with it later on. With that, I think I went 20 seconds over.
All right, well, thanks, Dave. And we're going to shift gears here a little bit from more of the business, corporate, interstate type issues to some individual issues. One that's always a big topic here in California has to do with changing residency. So Dave Spence will take us through the state of the law on residency.
Thanks, Roger, and thanks, Dave and Monica. So you've hired the Royce Law Firm to form your business. You've run a very successful business. You hired Monica and Dave to advise you on your tax credits and your sales and use tax issues. You've been very successful. Now you're ready to exit your business. You've got a buyer on the line, maybe a couple of people talking to you about acquiring your company. And you all of a sudden realize that you've got a California tax liability if you sell your company of about 13+% on top of your federal income tax liability. And so, and I say this because in the last, I'll say 6 to 8 months, I've had many clients come to me and ask, is there anything I can do because I've got this ugly tax liability if I sell my company? And so there are a couple of ideas. Number one, how can I leave California? How do I get out of California and therefore the Franchise Tax Board won't tax me on my sale of my company? Or, in the alternative, is there some way I can make my income leave California? So those are the two questions I'm going to talk about today. I'm not going to address, there are lots of other issues that arise in the scenario that I described, but those are the two questions I'm going to focus on today. And I'm going to try and get us out of here in a reasonable period of time. So just to keep in mind, California taxes non-residents. So let's say you moved to South Lake Tahoe, the Nevada side of the border, 5 years ago, and you've been running your business here in Silicon Valley, but you've been living, again, Monica's air quotes there, you've been living in South Lake Tahoe. California, just as a reminder, does tax non-residents, and it essentially applies a tax rate based on what would your tax rate be if all of your income were California income, and then applies that tax rate to your California income. So CTI in that slide, oh, excuse me, I forgot to change the slide. So this is our formula. California taxable income times California tax as if you were a resident divided by California taxable income as if you were a resident. So the question is, what is your California taxable income? So the argument, of course, is a general rule, and this is applicable certainly to California law and the law of many other states, is that any stock that I own is deemed to follow me wherever my residence is. So if I own stock in a California company, but I live in Wyoming, just because I have stock in the California company does not necessarily mean that the sale of that stock is going to create California source income. It could, depending on some of the other facts and circumstances, but generally speaking, so for example, if I own IBM stock, and IBM is a company whose headquarters are in Connecticut and is probably incorporated in Delaware, I'm not paying Connecticut taxes when I sell my IBM stock. California is going to tax non-residents, but if my stock follows me when I leave California, then maybe I can avoid that California taxable income component. How do I become a non-resident? Well, of course, the law provides a safe harbor, which is almost, who qualifies for this? Not very many people in the scenario I described. You have to have lived outside of California 546 days. Now the question, my first question is, 546 days, how did they arrive at that number, which is kind of, if you subtract 365 from that, you end up with 181, which is 1 day less than half a year. I'm not sure why that is, but anyway, 546 consecutive days outside the state. and your intangibles-based income is under 200K, and, oh, this third one, principal purpose is not tax avoidance. So that's kind of a hard safe harbor for the person who has an oncoming liquidity event. So what happens next? The alternative is you have the dreaded facts and circumstances test. Okay, do you have California ties? And of course, I mean, are your closest ties to California? Not do you have a picture of the California flag on your tie? So where are your closest ties? Are they to California or are they to South Lake Tahoe? Well, if you have a casino in South Lake Tahoe, then maybe your closest ties are to Nevada. But if you're running a tech company in Silicon Valley, you know, the fact that you live in South Lake Tahoe or you have a house in South Lake Tahoe, oh, by the way, your kids go to a private school in Silicon Valley, you know, that's not going to look good. So how do I become a non-resident? Where are my closest ties? These are some of the factors that the Franchise Tax Board is going to look at. And I purposely put them in here in a rather unreadable way because they're not. It's not intended to be an exhaustive list. It's just kind of a list of some of the things that the Franchise Tax Board may look at in determining whether you in fact have left the state of California. And so it looks at social ties, it looks at your legal ties, it looks at your professional ties, and it wants to know kind of, do you look like a real resident of South Lake Tahoe, or do you look like someone who lives in San Jose? Okay. So let's assume then that that particular option is not going to be very attractive. You still have kids here. You don't want to take them out of school and put them in some school in South Lake Tahoe. And so moving out of California for that 13.3% tax that you're going to get hit with is not a attractive option, or at least it doesn't sound attractive to your significant other. So now what? How can we shift our income outside the state of California and maybe avoid some California tax in that way? Well, what I wanted to do today is just present to you, or for those of you who are familiar with it, remind you of a technique that's kind of been in development for probably a little over a decade. And there have been a number of private letter rulings and so forth on this issue, but it's a technique called a Delaware Incomplete Non-Grantor Trust. And it's actually an incomplete in that context means incomplete gift, which means our objective here is to create an entity that will own the asset that we're going to sell, and and that entity will be the taxable entity when the asset is sold. But we're going to do that in a way that is going to avoid federal gift taxes. So, and we use Delaware for reasons I won't get into right now. It's also being done in Wyoming and Nevada, to name two. Can also be done in a couple of other states, but I just like the term ding, so I use Delaware. Anyway, so here's kind of how that ding structure works. You, the taxpayer, are represented by the yellow smiley face there, and you transfer your stock in your company or your valuable appreciated asset to a trust that is located, in this case, in Delaware. It could be Wyoming, could be Nevada, it could be South Dakota, it could be a number of other places. That trust has certain terms that cause it to be considered an incomplete gift and therefore not subject to U.S. gift tax, and also a completed transfer, and therefore, upon the sale of that transferred stock, the trust becomes the taxable entity and not the yellow smiley face. So the transfer of shares goes to the Ding Trust. The Ding Trust has obviously a trustee that is located in this example in Delaware. In addition, and I didn't put it on this slide, it's going to have a committee, what we call a distribution committee. And that committee essentially divides up the power to distribute assets and or income from the trust such that it is not an unfettered power on the part of the grantor, and it's not an unfettered power on the part of any one individual. And then that trust, under its terms, dictated by the grantor, the yellow smiley face, that trustee has the power, with the consent of the distribution committee and the consent of the grantor, has the power to trickle, and you'll see my arrows here are, pardon my illustration, it's intended to look like water droplets because it's a trickling of assets, income and or principal out of the trust to my designated beneficiaries, be they my children, my cousins, or whomever, or in fact it could be distributed also back to me. And that structure, if properly drafted and executed, and I emphasize that both of those are important, not only the words on the page, but how it's in fact operated, can have the effect of the transfer of the shares to the trust being a transfer to beneficiaries, but with sufficient retained interest such that it's not considered a completed gift for federal gift tax purposes, and therefore no gift tax on the transfer. And yet it is a completed transfer for purposes of federal, or for purposes of not only federal but also state income tax on the trust income. So the idea is then when it's time to sell the shares in the company, the Ding Trust is the seller of those shares, and if, by the way, that Ding Trust is in fact located in Delaware, then Delaware's state income tax on that would be 0. And then the key is, does that Ding Trust have any California tax liability? And there are a couple of issues with this technique. I don't have time to get into them now, but we can, if anybody would like to discuss this technique, I'd be happy to just reach out to me via my email address, and we can have a telephone conversation. We can talk about some of the issues that we have to deal with. But the idea is that I can shift that income outside the state of California. And there have been a number of rulings that have supported that ability. And in fact, a general counsel memorandum, a chief counsel memorandum on the issue from the IRS. But beware. There are remaining issues with this Ding. Wing would be Wyoming Incomplete Non-Grantor Trust, or Ning, which is Nevada. There are some issues. Number one is that it is relatively untested with regard to California income. Conceptually, it should work, but as yet, we don't have a lot of reported either franchise tax board positions or case law on the subject. At least not satisfactory to me. And then anytime you have a lawyer-created technique like this that is not specifically contemplated by the statute, there is a certain amount of risk. And so any client who wants to undertake a strategy like this needs to be aware that there's a certain amount of risk, and be prepared for having to respond to some inquiries from the IRS, and potentially more than that. And number 3, California has something called a throwback rule. And so the throwback rule essentially says that if I create a trust, ignore the ding factor right now, just any type of trust that accumulates income outside of California and then distributes it back to California within a 5-year period of time, that income will be taxable as if it had been taxed in the year in which it was earned outside of California. So it essentially treats the taxable income as having been distributed to California beneficiaries in the year in which it's earned, if it's distributed back to those beneficiaries within a 5-year period of time. So this ding, wing, ning strategy is not for everyone. It's also not for someone who's just looking to get the money immediately back. That's not going to work. But it can be a valuable technique, and we're working on this type of strategy with a number of clients right now. It can be a valuable technique for the right client. And with that, I think I went a little over, but I'll turn it back to Roger.
Okay, thanks very much, Dave. I think we got the most content per minute out of this webinar as we have in a long time, and we've got a little bit over our time. I want to remind everybody that's listening that this webinar has been recorded. You can find it at royceuniversity.com. You'll also be able to find it on the Royce Law YouTube site, and it's available for download as a podcast in the Apple Store. And the slides are on SlideShare, or they will be shortly. Finally, I'd like to let you know that our next webinar will be coming up in mid-January. It's on film tech. We'll probably do one a month now for the rest of the year, now that we've kicked this off. I know several of you have questions. If you have questions, please email us, and we'll have our panelists get back to you directly. And with that, I am going to conclude the webinar. Thank you very much.